I mean, obviously, there's always volatility in prices of any commodity. But what I did was I thought I ought to have a look at metals prices in the context of the longer term, and particularly silver. Now, silver has been behaving as an industrial metal, and I've got a basket of base metal prices going all the way back to 1900. And if you price that in gold, that is quite revealing, bearing in mind that over reasonable periods of time, and I'm talking about decades, centuries, millennia even, the purchasing power of gold is relatively constant. I mean, the reason for this is that gold is accepted everywhere as money, and unlike Bitcoin, the supply increases, and it increases at a rate which, while it can vary, is more or less in line with the global population. So you have a stability, if you like, when you price anything in gold. And we certainly saw this up until the point where the Bretton Woods standard collapsed. The point is that if you take the prices at the beginning of the last century, so we're talking about over 127 years, you can see this stability in a basket of base metals priced in gold. But interestingly, recently, the value of these base metals priced in gold has actually declined quite significantly. And this year, it's standing at a roughly 77% discount to that 1990 level. Now, it always returned back to that level. Sometimes it'll go over, sometimes it'll undershoot, whatever. But what that indicates is that irrespective of what's happening to fiat currencies and their purchasing power, these base metals as a package, we can expect them over a period of time, we don't know how long, to increase roughly 3 to 4 times. Now, that is before you talk about the debasement effect of fiat currencies on metals prices. Now, this is very important. What it tells us in a nutshell is that base metals are more underpriced than they have been in the last 125 years. So this has significant implications. If we're looking at other commodities, you're going to get a similar sort of message. And therefore, the implications for consumer prices, let's say on a 5 to 10 year view, is that they're likely to go considerably higher. So the rate of inflation, if you like, even though the government suppresses the numbers, will increase. But returning to silver, silver has been priced like one of these base metals, and there's nothing in it at all in terms of premium for its monetary role. But I think that is also going to return because gold is very, very under-owned, and it's a racing certainty that as members of the public begin to catch up with what's gone on in gold, they will, at the margin, prefer to buy silver rather than gold on the basis that gold has already gone up and silver, has been left behind. So the other thing I would throw in is that this underpricing of metals as a whole is now leading to indigestion, if you like, in the papers markets. If you look at the best performing commodities this year so far, platinum, palladium, copper, silver, gold, it is extraordinary. And this is reflecting just how undervalued metals as a whole, precious or otherwise, have become. So if you get some sort of crisis and a flight into the dollar, here's what happened in 2008-9, people haven't got the gold to sell. They'll sell something else. So this is why I feel the downside in gold is very limited. And of course, the other thing is, and this is desperately important, it's not so much the gold price has been rising, but the dollar has been falling. So much so that we've even seen this in the trade-weighted index. So in short, there is a lot of catching up to do. And I think it's all part and parcel of the swan song, if you like, of fiat currencies. What you say is perfectly natural because you account in dollars and you pay your taxes in dollars. And so from the point of view of whether you're up or down, your risk-free position basically is cash dollars. But this is all an illusion because what you're looking at is credit. It is a credit risk which depends on your faith in the Fed. And because it's a Fed's dollar, in turn, of course, the faith that you might have in the Fed is going to depend very much on the faith in the US government. Now, the reason that foreigners probably recognize this first and domestic users of the dollar recognize it last is obvious because foreigners, from their point of view, their risk-free position is their own currency. So, let's say, a Brit investing in dollars or whatever, he sees risk because he is accounting in sterling. He pays taxes in sterling. He makes his profits in sterling. So you can see that foreigners are a lot more sensitive to what's going on, let's say, in a foreign currency than domestic users. Domestic users, they don't actually understand, the difference between money and credit, gold being money and the rest being credit. And the second thing is that they assume that all the price changes they see prices rising. They think it's not the dollar going down in terms of its purchasing power. They think it's items rising for whatever reason. I mean, they call it inflation. Actually, inflation is a description of what happens to the quantity of credit. It's a complete misnomer when you're talking about what's actually happening to prices. Prices are rising, they're not inflating. Now, that's a different thing. The only way to look at it really is to understand that the dollar's value in transactions is not a constant. It is something that is moving all the time. And for a long time, it's been moving downwards. If you look at it in terms of gold, I mean, going back to 1933, you had $20.67 to an ounce of gold. Now you've got $3,400 to an ounce of gold. Does it tell you gold's gone up? No, it tells you the dollar's gone down. And we've had a constant stream of crises ever since 1933. And first of all, there was the devaluation of the dollar. I mean, this is an interesting one because people will say, well, they rose the price of gold from $20.67 up to $35. Really? Actually, what they did was they devalued the dollar by 40%. And then, of course, you had the Bretton Woods thing in 1971. Nixon said he suspended it, to stop foreigners speculating and all this sort of garbage that politicians talk about when it comes to what they think is money. So this is the message which everybody's got to understand, and this is why the last people who understand it are the people who sort of wake up to the fact that it's not prices going up, but it's the currency going down. And when people actually do understand that, the currency is doomed. We are not there yet, but we will go there. Well, they're all in the same boat. I mean, just look at it from 2 points of view. I mean, in the G7 nations, they've all got high debt to GDPs, and when interest rates rise, and they are rising, do not believe that they're falling. If they fall, they're being suppressed, and that kills the currency. You can see that which way this is going for all these currencies. It's almost like a race to the bottom, if you like. The thing about the dollar is that the dollar is the most important fiat currency. And there will come a time when the Dixie starts rallying for the very simple reason that everything else is falling faster than the dollar. That, I think, is going to happen. My own view on sterling is that sterling is in a huge, great mess. Or more accurately, I'd say that government finances are in a horrendous mess. And so far, this has been ignored because where is the attention? The attention has been on the wonderful President Trump and all his running around and upsetting things and all the rest of it, and trade and big, beautiful bills and so on. So in terms of bad news, he's been stealing the limelight. That's going to shift. It will shift at some stage. I don't know when. I don't think it'll be terribly long. So the idea that the Dixie is going to go down and down and down and down is actually not the way to look at it. The dollar is going down and down and down against gold, not Dixie. So, some people argue that President Trump wants to see the dollar lower. I think he's talked about it. He certainly wants interest rates lower. And I think his attack on Jay Powell is actually very misguided. I think that's a very stupid thing to do. As indeed, from a foreign point of view, most of his trade policies are completely nonsensical as well. So all other currencies are basically in the same boat. And we can see that the yields on longer JGBs are on the rise again. I think we're hitting new highs for sort of 20 odd years or something on the yield on the 10-year JGB. And if you go longer, apparently there's absolutely no market in the 30 and 40-year-old maturities. So, what's going to trigger that, a new phase in this crisis? We just don't know. With everybody in the same sort of mess, to greater or lesser degrees, it could come from anywhere, which makes me think that, anyone who sort of thinks, we'll muddle along a bit longer, I think is holding a hostage to fortune. I really do. Yeah, well, there are 3 acts that have come up. The first one has actually been passed now by both Congress and Senate, and that is the Genius Act. And the 2 further acts, which are still progressing through the legislative process, are one to move regulation of stable coins, away from the SEC to the CFTC. And the last one, which is very interesting, is banning the Fed from issuing a CBDC. But Genius is interesting because what it does is it embraces stablecoins. I think that there are 2 reasons for this. The first is that stablecoins issued by the banking system impart no risk to the banks at all. And the great thing about it is that you can expand your stablecoin exposure as much as you like. Well, the reason for this is that if the bank issues a stablecoin to a depositor, the other side, on his asset side, under this legislation, Genius legislation, basically, he's got to go and buy US T-bills or whole cash or readily accessible cash. In other words, he's got absolutely no risk at all in the sense that 3-month treasuries bear no risk at all. This is regulatory fact. So I mean, at the moment, I was looking at the 3-month T-bill and the yield on there is about 4.35%. So you pick up 4.35% on the other side and you are banned from paying any interest on your stablecoin. So you've got a clear margin, no expenses. I mean, how wonderful is that? Of course, the banks embrace this. I think the problem is that the expansion of stablecoins, I mean, at the moment, I think it's around about, I can't remember the figure, something like 300 billion or something. It's not huge, but the expansion of that market isn't actually tied to banks saying, oh, we got this wonderful new stablecoin product. Switch over your deposits, which give you 2% or whatever. Buy these things which give you nothing. I mean, that's not a very good marketing ploy. So I really just don't see that there is any other driver for this than the expansion or not of crypto use. They're used in payments and settling, and that's where the regulation is being applied. So that makes sense. I think the Treasury quite likes the idea. I mean, it's got no objection because, it helps fund at a time when it's having great difficulty funding, the increasing amount of bonds which are being rolled over every year, as well as, ongoing deficits. So the Treasury is quite happy with it. And here's an idea for those who want to come up with a plan. And that is, what you do is you put together a package. You put together a stable coin, an assembled stable coin, if you like, which is comprised 50% of gold bullion and 50% stable coin. What that means is that you can market this as portfolio diversification. Your stable coin is absolutely free of risk. Yeah, so you got your $50 as it were. And the bank merely, or the financial institution issuing the stablecoins, merely buys in gold to cover the rest.